The Controller's Office, 1 Center Street, 530, New York, New York, New York. Lee Tian will do the roll call, trustees.
Ms. Janice Emery. Here. Mr. Larry Schloss.
Yeah.
Mr. Justin Hall.
Present.
Mr. Steve Cassidy.
James Sullivan and Steve Cassidy's proxy.
And Mr. James Evans.
Here.
Mr. Robert Schwab.
John Kelly, Bob Trump, proxy.
And Mr. Don Kelly.
Present.
Mr. James McGowan.
Present.
Mr. Patrick Reynolds.
Here.
Mr. James Alonda.
Here.
Mr. Sean O'Connor.
Here.
Commissioner Steve Rush.
Present.
We'll have 24 votes in a forum. We can start a meeting. In the public session.
Okay, everybody have their quarterly reports? You don't, Mark?
Takers?
We have a brief public session. We're just going to go through the. Wow. We're just going to go. Thanks, Martin. We're just going to go through the quarterly and the April results, all of which are good. So, Martin, you can walk us quickly through old news.
Quickly, yes. So the March quarter was a very good quarter. Larry showed preliminary information previously last month, actually just a couple weeks ago. And in short, the March quarter was bullish for virtually all risky assets. The Russell 3000 was up over 11% for the quarter. Non-U.S. developed markets were up by more than 5%. Emerging markets were roughly flat for the quarter, but are still up over 12% in fiscal year to date. High yield continued its rise, was up over 2.5%, and REITs were up over 5%. For core fixed income, because interest rates rose a little bit, recently they've risen. Larry will talk about that in a little bit. The investment grade 4+5 was roughly flat. In U.S. equity, small cap and mid cap did better than large cap, and value was ahead of the growth. But if we want to see how the total fire fund did, it's on, if you turn to page 9, you will see that on the left the return was 507, a very strong absolute number, and also ahead of the benchmark of 490. And the fiscal year to date through March is just shy of 12%. It was 1199, 30 basis points ahead. We'll show you April in a moment. Larry will, where April was another good month, and so the numbers to date is even higher than that. The 1-year number was just shy of 9% behind the benchmark, and the 3-year number is 9.64% behind the benchmark, and the 10-year number is just shy of 9%. The next few pages show the asset allocation, and if you turn to page 11, you'll see where the fund was positioned as of March 31st, and we'll have an update in just a few minutes on April. But it would look similar to this. We're overweight U.S. equity, slightly underweight non-U.S. equity, and we're underweight 4+5 tips, and slightly overweight high yield, which has been fairly consistent over the last several quarters. And as you'll see in a moment, has helped the returns on page 12. We have attribution for the quarter ending March, and in a strong equity market where fixed income didn't do as well, and you have an overall 5% return, and U.S. equity did 11%. And overweight U.S. equity helped, and underweight the core plus 5 tips also helped, and that's why the allocation was a positive 39 basis points. The management effect was negative, primarily because of timing differences with private equity in a strong bull market. We've seen this before. We've talked about this before. Private equity lags, and so it'll catch up to the public markets in another quarter or two. For the 1 year ending March 31st, the allocation effect was slightly negative and the management effect slightly positive. The primary drivers there were cash that we had before the allocation effect and the management effect was roughly flat, but 4 plus 5 definitely helped. And then we have the 3-year attribution, which is very similar. Summaries are on pages 15 and 16. Just want to point out on page 16 for domestic fixed 4 plus 5, it's not 21%, it's 0.21, so there's a decimal point missing. Page 17 shows how fire has done versus other large public funds, defined as greater than $1 billion. And you turn to the left, most bar, and you look at the numbers on the bottom, you'll see the fire was in the second quartile with 507, in the 40th percentile, and for the 1-year number, the 996 was in the 65th percentile, but the 3-year number was again above median, and 4 years just outside of top quartile, well within the second quartile. So the numbers are pretty good and have helped bring the returns and market value up to well over $9 billion. And unless there are any questions, I'm going to turn it over to Sina.
Okay, thanks, Mark. If you turn to page 21, just a high-level view of your domestic equity returns relative to the benchmark. And there's good news here in the quarter for March. As you can see in the blue bar, that's the fire's total returns versus the benchmark, the Russell 3000. So up about 60 basis points in excess. And the fiscal year-to-date number, also good, up nearly 50 basis points in excess. As you remember, we made some changes around some of the managers and also in terms of the underweight large cap and overweight mid cap and small cap US, which actually helped. And some of those details are on the next page. So if you turn to page 22. US equities, roughly 36% of the total funds. And as you can see from the pie chart, the majority of the money is invested passively, almost 70% passively. And I'll just point you to a couple columns that we talk about a lot, the index return, the actual return, and the difference columns. So you can see in the index return, like Martin mentioned, the Russell 3000 index fund, which is several rows down, up over 11%. But you can see the outperformance here relative to large cap in the mid cap S&P 400 index, up over 13%, and the small cap index up over 12%. So our positioning there has helped us. It's also helped us in the fiscal year to date as well. And actually, most of the active managers did well relative to their benchmarks and outperforming. If you turn to page 29, it goes through the international equities. You can see here about 15% of the total funds. And if you look at the pie chart to the left, it's kind of the opposite of the U.S., where more of the money in international is invested actively, about 82%. And then again, going to those few columns, the index return, the actual return, and the difference column. Again, as Martin mentioned, you can see here how the U.S., as measured by the Russell 3000, up about 11% relative to the EFA passive, if you see there, in that column, up a little over 5%. And then if you go down to the passive EM row, you see that the emerging markets were down about 150 basis points for the quarter. If you turn to the next page 30, it goes through some more detail on EFA. You can see in the quarter, the purple bar being the fire portfolio in EFA, and the yellow bar being the index. A little behind in the quarter, a little behind fiscal year to date. You might remember that we've been transitioning the new EFA managers and out of the old EFA managers after we completed the search late last year. So that's still going on, and it's done, and so you'll start to see those numbers over the next couple quarters, and we expect those to be better numbers in active management for EFA. If you turn to page 35, this is emerging markets. A little detail here. So as you can see, barely in the purple bar in the quarter. It's a good sign, it's flat, basically. Versus the index, which is the yellow bar, So, and you can see the blue bar there, up about 60 basis points relative to the benchmark being down 150 basis points. That's your active managers. And you look at fiscal year to date, also outperforming overall, and the active managers nicely outperforming the index. You might remember we did our new emerging market search earlier last year, so our new active managers are starting to deliver the kind of returns that we would hope to see. So if you turn to page 37, lastly we'll go through hedge funds. So currently about 3% of the total funds. Our goal is to get to 5%, which is the policy. And we are bringing a couple of managers today. So if you look in the quarter, the blue bar being the fire portfolio, and the couple benchmarks to the right. So a little behind the HFRI plus 1%, ahead of the T-bill plus 4. Fiscal year to date, though, nicely outperforming both benchmarks and also in the trailing 12 months. Still early days, but so far so good on the hedge fund portfolio. Now I'll turn it back to Martin if there are any questions.
Before we go on as well, this is Bob Stroud, okay?
Turn to page 39, we have a summary pie chart of your exposure to fixed income. You'll see $3 billion, or about a third of the assets are invested. The largest allocation is shown in blue, which is the investment grade Core Plus 5 program. And that's further broken down on the next page. 18% of the total fund is invested here. And as you see in the under and overweight column on the bottom, we've been underweight treasuries for several quarters now and overweight the spread sector. In this particular quarter, that helped because the worst performer was treasuries as rates rose. Larry's going to talk a little bit about April and then May, where volatility has increased even further. But in addition to having those allocations right for the quarter, the managers in each of the sectors outperformed. So that was good news. And that actually shows, and it's also the magnitude shows as well. So on page 41, where the returns are shown, it's roughly flat line for performance, but the overall benchmark was negative, so it's 37 basis points ahead. But for the fiscal year to date, where the returns are fairly modest as yields start creeping in, the low yields start creeping in and affecting returns, and for the one-year number, the trailing 12 months, the outperformance by over 100 basis points in very low volatility has really helped performance, especially in an asset class where you expect going forward to have low returns, and you'll see the longer-term returns are in the 6 to 7% range, also ahead of the benchmark. Tips is a similar story. Volatility has dropped off. Obviously, it's picked up in the last few weeks. It was negative, slightly negative, just below flat line for the quarter, but it was ahead by 10 basis points. Fiscal year to date, about over 2.5%, 20 basis points ahead, and the 1 year up nearly 6%, over 20 points ahead. And like I said, volatility has dropped off during the period. High yield keeps chugging along, and for the quarter, another 2.75%. And in addition to that, that includes 85 basis points ahead of the primary benchmark shown in yellow. Fiscal year to date, we're already up 10%, and that is also ahead of the benchmark nicely. And for the 1 year number, up 11.75%. 10-year number, 5-year number is remarkably 10.34, and the 10-year number is almost 9.5. All ahead of the benchmark, but I want to point out that the 3-year number where we have 10%, it's on 6% volatility. That's the chart shown below. And the 5-year number, 10-year number, also the returns are on very low volatility, which yields a higher Sharpe ratio. And effectively, it's been slow and steady for the last 4 years now in enhanced yield and high yield. Convertible bonds are on page 44. The returns are shown in blue. 571 is the return for the program, high absolute level of return, but behind the policy benchmark of 788. We've taken steps, as you know, in previous meetings to address the underperformance of this program, and you'll see that the purple bar, I think that's purple, which is the custom index of which is the index, weighted index of the managers of the program, not the program index. The manager was actually ahead and was roughly flat fiscal year to date. The returning 1241 while behind the overall policy benchmark of 1545. And that dynamic continues going back in time as well. But going forward, we believe we're taking steps to address that. Opportunistic is on the next page. This is where some of your highest returns of fixed income are shown. A strong quarter ahead of all benchmarks. Strong fiscal year to date over 10% through 9 months, and the 1-year number over 15%, and the 3 years over 11%, so meeting the objectives of the program to date. Again, the program, which we've evolved from fund structure to strategic mandates, is in its early stages, but it's proceeding very well. And with that, I'm going to turn it to Kathy.
Try again. Turn again. Liz.
Liz, P.
Okay, so I had the private equity quarterly report in December 31st, 2012 on page 18, so I'll start.
Page
18. Okay. So for the fourth quarter of 2012, you Fire made had a total since inception commitments of $1.2 billion across 133 funds, which represents 87 partnerships. For the quarter end, you had $785.5 million of capital commitments, got back $472.7 in distributions. Have a market value of $5.75 million, and that gives us a total value of $1.047 billion. In terms of your performance since inception, you got generated a total value multiple of 1.33 times and an IRR of 10.3%. So if you want to see how that performed against the benchmarks, you take a look at page 19 at the bar chart at the top of the page. And you'll see that, again, your IRR since inception came in at 10.3% at par with the Russell 3000 plus 300 basis points, which also was at 10.3%. And then overperforming the Thompson One Media and Venture Economics, so they came in at 3.8%, so a nice performance there. And just a very quick snapshot of the activities in the fourth quarter. Just turn to page 29. And you'll see for the fourth quarter, we closed on 4 new deals for Fire, totaling up to $49.2 million in ICB 3, Carlisle 6 Sidecar, which is the co-investment vehicle that's specifically for Fire and the New York City Retirement Systems, as well as Platinum Equity Partners. And then subsequent to the quarter end leading up to mid-May, we made 3 more closings in Landmark 15, the Landmark Sidecar, which was basically the co-investment fund. Again, that's going to benefit Fire and the New York City Retirement Systems, as well as Aequan Equity Partners 3, for a total of $36 million. So if you want to see which strategies are working for you and who's performing and which way, you look at page 32. And then you'll see the table at the bottom of the page shows all of your sub-strategies and see how everyone's performing. And then based on IRR, you'll see that the top performing strategy for you is large buyout, which came in or generated 26.9% IRR, followed by special situations and secondaries. Secondaries came in at 21.8, special situations at 21.3, and then growth equity at 19.2. So nice growth and nice IRRs that you're seeing in those strategies. And then the last thing I would point out, to end on a very nice So to end on a nice note and a happy note, go to page 36. And this is your cash flow activity. This is really where the nicer story comes out. This is your cash going out, which are the bars at the bottom, the bar chart, the darker bars, and the cash coming in. And you'll see that this is year over year, and since this is the year end for 2012, you'll see that year end you had a really nice high distribution of $123.6 million. That's higher than it's been for previous years. So all trending in the positive direction, and that's it for the quarterly report.
Okay, staying in the same book, on page 48, we review the highlights of the entire real estate portfolio for the same quarter, fourth quarter 2012. As you know, there's a 5% allocation to real assets. 3.6% right now is funded in real estate, and that represents a market value, dollars in the ground, of about $309.2 million. We have about $112.6 million in commitments that we have yet to fund, and altogether our exposure to the asset class is $421.8 million. At this level of exposure, the portfolio is about 35% core, 65% non-core. This is a temporary overweight that we approved tactically, and it makes sense given the fact that initially, as real estate recovered, investors had a flight to safety, and so they were investing in the primary markets such as New York, DC, San Francisco, and loaded up on apartments and office, so much so that these particular property types are at values at pre-recession levels. So in terms of the 29 managers that are actively investing in real estate for the FIRE portfolio, they're kind of selectively looking at that core space. Overall, right now, we're approaching 40 investments. We have 39 investments right now in real estate. The portfolio is well diversified in terms of geography and property type. It's a global portfolio. We are at 14% international at this point, so we're kind of halfway to our, more than halfway to our 25% goal. So if we just kind of look at the performance just for the fourth quarter, we had an outperformance of 90 basis points. The FIRE portfolio came in at 3.2% net compared to the benchmark at 2.3% net. The benchmark, of course, is the Odyssey. The Odyssey is a time-weighted benchmark. It's a core benchmark, and we have added 100 basis points to reflect the blending of the core and non-core portfolios. But real estate is slowly regaining ground. There's limited new supply. All the indications are pretty positive. Occupancies are up. Vacancies are down. I talked about the strength of the apartment and office sectors. We're now seeing the same things in the industrial and retail. So just to kind of give you a snapshot of how the portfolio is performing in the near term and over time, I take you to the graph that's at the bottom, where FIRE is depicted in either blue or the darker bar, and you'll see the benchmark, the Odyssey Plus 100, on an after fee basis in yellow or in the lighter bar. So in terms of the portfolio in the later years, at the 5-year mark and the since inception mark, you'll see some underperformance there, and that largely because it captures the global financial crisis, where there were some managers that had some mixed results. But I think that we have made those adjustments. We are focused on top-tier managers, top-tier performers, and our post-recovery commitments have been very strong. And you can see that in the performance. I just talked about the quarterly performance. There's outperformance for the 1 year and outperformance for the 3 years. So in terms of what managers we can attribute the outsized performance to, we have smaller managers like H2 and Dipco West. We have larger managers like Carlyle and Blackstone. In terms of what we've been doing since the fourth quarter, we've been active. We've made some commitments, and we've also closed on some commitments. So in terms of the deals that we've closed on Emmis and Related. We've also have 3 other deals that are commitment and will be closing shortly, hopefully before the end of the fiscal year. And lastly, I would say for those that are interested in the since inception return on the dollar weighted basis, we have an IRR of 1.5% and a multiple of 1.0. Any questions on real estate?
Perfect. So great quarter, good work. Now we'll get to April. Do we got one of these for April? Living color. extra, kill the 2 trees. Okay, so April's going to be another good month. But we're going to have a little trouble is in May. But let me walk you through April, and then I'll get a little bit to May. So let's start on page 34. So 34, again, look on the far left. You see the top block as the U.S. stock market was up sort of 1 to 2%. EFA had a pop, so it was up 5%. Emerging markets were up a little less than 1%. The bond market was up sort of 1 to 2%, regardless of credit quality. So that's a pretty good month. You know, it's a calm, make some money kind of month. And if you go to page 30, you can see how we're set up. Actually, go to this new page that Martin handed out. These are the numbers that go with the pie chart. There was some error in the original page 31, but what it basically shows you is basically the same way we've been for the most part of the fiscal year. We're overweighted U.S. equities, underweighted governments, underweighted tips. We're slowly taking down our overexposure to high yield, as we've been doing for the past couple of months. If you go to page 35, the combination, remember most of the stuff was up 1, up 2. So if you go to page 35, we were up 1.7% for the month, which gets us to about 14% for the year. I'm afraid that might be the peak for the year, up 14%, and I'll get to that in a second, not to ruin your parade here. So if you go to page 27, 27 shows you is total assets of the fire fund. It shows you that we're at $9.3 billion. We came in under $8 billion to begin the year, so that's good. It's the highest ever again. And then again, if you look on page 28, you can see that on a 10-year basis, we've clearly gone through the gap in 08, 09. 10 years, we're making about 8.5%, all pretty good. So then May came along, which I don't have the numbers for you yet, but I'll give you a glimpse. May came along, and Ben Bernanke made a presentation to Congress where he sort of said, you know, at some point I'm going to take my foot off the gas and stop buying 85 billion bonds every month. And that sort of spooked everybody because he had prior said, you can count on me until the summer of 15, which is far enough away that people weren't worried about it. But if he's going to all of a sudden change the rules, the bond market reacted pretty violently. Violently being, before he spoke, a couple of weeks before, the 10-year was at 1.6%. Today, the 10-year is at 2.25%. That's a big change. Everything backs up from that rate, so the investment grade stuff's backed up, the high yield stuff is backed up. And it's really only about 10 days to the May numbers. So May we're kind of flattish because the stock market's going up. And June is now looking very, very choppy. The stock market's down today, the bond market's down as well. So we're going to have, you know, we got plus or minus 3 weeks left in this fiscal year. It reminds me a little bit about 2 fiscal years ago where we lost a big chunk of money in June, but we kind of started with a big running head start. So we have a big running head start. We're up about 14%. Again, I think May we're pretty flat to down just a skosh. So June, we'll all live it together, but it's much more volatile than it's been. You know, I think the Fed's tried to back off what Bernanke said a little bit, but it's a little bit like once you open the door, everybody's sort of just trying to pile out as fast as possible. So we'll just have to see where we are. We're set up as well as you could possibly set up for this, because again, we're at the bottom end of the ranges on 4+5 and bottom end of the range for tips. And again, we can take it down to overexposure to high yield. So, you know, markets are what markets are. But again, we got 3 weeks left, a bunch of volatility. I'd like to think we'll lose just a little bit of money in June, but as long as people keep calm. But again, what comes out of the bond, it's interesting, what comes out of the bond market does end up in the stock market. It's just what the Fed wants you to do. You know, how it works in the next 3 weeks, I don't know. We'll see. but more volatility. If you look at, if you remember each of the months of this year, and if you look at page 27, it's pretty much been up all year. So if you back it off a little bit, I mean, that's sort of life. I'd like to hope we can keep a 9-digit for the fiscal year. I just think that'd be a cool number to have. That's 3% room from where we are, so hopefully we don't lose 3% in the month of June, but it would be just that. It would be 3% in the month of June. So stay tuned. As soon as we get an early indication of what the fiscal year looks like, we'll get the numbers to you. Any questions on April and sort of a glimpse into May and June? Okay, Callie, you want to go back on what was cooking in
Yes.
ETIs in the first quarter? What page should we go to?
The quarterly report on page 46.
This big one?
Yeah.
Go back to the big one on 46.
Page 7.
Page what?
46. 46.
46.
Quarterly report.
So if we look at the performance of ETI, we see that ETI did well this quarter. It outperformed all its areas, all the years. It speaks for itself. And if you turn to the big book, page 7, that will show you the activities of what your actual ETI investments did.
What page?
Page 7 in the big book. And the highlight for this quarter, actually, if you turn to the AFL-CIO activity on page 9, is that the AFL-CIO invested $89 million in amalgamated Warbass housing in Brooklyn this quarter, and it was actually related to some Sandy-related repairs. And Warbass is a Mitchell Almond development. So that was the highlight for this quarter.
Okay, thanks. So that ends the first quarter, that ends April. I'm afraid April might be the best number to see for the rest of the fiscal year. Stay tuned for July. Let's see if we can have a bumpy but calm landing of the fiscal year. Any questions?
I just got a question related to the monthly reports, but indirectly regard. I noticed in these reports, and we've been seeing them for a long time now, that we get a lot of our charts and pricing and information from Bloomberg. And I understand we have multiple terminals here in the office, and I wonder if anybody has made any inquiries in regard to the recent scandal with Bloomberg about snooping on companies, and if it's related to any stories that may have popped out in the controller's office. There has been a few over the past couple of years.
We have about a half dozen Bloombergs scattered throughout BAM. I think we use them as a data source as opposed to trading firms like JP Morgan or hedge funds or investment managers that really live on them. We really just use them as resource for these kind of charts. All of our confidential information is not on Bloomberg. It's all at our custodian back in New York. We don't even use the emails on Bloomberg because we have our own secure email. So there's really nothing that you can snoop around and find on our Bloombergs that have anything to do with anything. We're minimalist Bloomberg users.
We use it for the data.
Okay. So I just, wanted to, maybe if everybody felt comfortable, just get a letter from their Bloomberg counsel just stating that, there's been no link to anything with BAM, with the Bloomberg terminals. And,
Okay.
yeah.
We'll look into that.
Thank you.
Good idea. Okay. So that ends the the public session. Please, all right.
We now need a motion to move out of the public session and close the meeting. We will start the firefighters variable supplements fund meeting now. We'll call the trustees. I'll make a motion.
So moved.
Second. Any opposed? Motion carries. Is the camera off?
firefighter variable supplement fund meeting. Ms. Janice Amory. Here. Mr. Larry Schwab.
Here.
Mr. James Levis.
Here.
Mr. Robert Rob.
Here.
I have no full votes and the quorum, we can start a meeting.
Okay, so this is going to be quick. If you turn to page 3 of the quarterly report, you see the total return for the funds for the quarter on the left. The fund, by the way, was valued at $407 million. Now, again, it's a strong 6% return. It's behind the benchmark. The strong fiscal year-to-date returns of over 12.7%. That was behind the benchmark of 13.41, and the one-year number is over 10.77. So it's been a good few years. The asset allocation is shown on page 4, and for this fund, the policy is much simpler than the other funds because of the need for liquidity, and so we don't have the alternative asset classes, and for U.S. equity is 50% of the fund, and we're slightly ahead of that policy, and we're slightly underweight Focus 5. And tips, we did have, after the December payment, we did have some extra cash because we overthrew the amount that we were expecting to have, so we put that back, overthrew the amount that we were expecting to have, and we put that back to the equity market at the time, and the equity market since then has run. The attribution is shown in the next few pages. Really the key thing to see is that the EFA portfolio, which is active in this case, I'll get to that in another page or so, underperformed, and that's the bulk of your management effect for the recent period, the quarter of the year, but for the 3 years, 4 plus 5 has done very, very well. For equity, it's quite simple. On page 11, it's over 70%, just over 70% of the assets dominated by the U.S. equity, and that is entirely passively managed, as you see on page 12. And as you would expect, the risk and return numbers are right on top of the benchmark for each of the periods, and it's 54% of the funds. Domestic, developed markets, non-domestic portfolios, EFA portfolios on page 13, are actively managed, and the manager underperformed for the 3-month and the fiscal year and the 1-year period, and that shows, and that's why there was that manager effect, negative manager effect that I mentioned before, although the longer term periods are mixed, 3 or 5 year are well ahead of the benchmark, but the more recent periods are not. Emerging markets is State Street, that's page 14. As I mentioned before, is flat to negative, and they underperformed the benchmark by 67 basis points on the left, and 75 for the fiscal year to date, but the fiscal year to date is still very strong, 1140. And the results are close for the 1 year and 3 year, and behind for the 5-year number. And 4% of the assets are invested there. We have REITs on page 15. Which has been behind the recent period, but still well ahead for the longer term periods, and that's Morgan Stanley. Fixed income on page 17, it shows you the pie chart, so it includes pieces, slices of the pie. By far the largest is the 4 plus 5 program. All of the managers on page 18, you see in the difference column, mortgages were right on top of the benchmark. All the managers except for the mortgage manager, which was right on top of the benchmark, all of them outperformed. And we were overweight, and underweights were roughly neutral due to the need for liquidity on December 15th. But the good news is, just like for the fire fund, because the managers outperformed very well, on page 19, while the returns are very modest, the outperformance over 100 basis points really helped in a very modest return environment for the fiscal year to date and the 1-year period. Tips, this is PIPCO. PIPCO's done very well. Flat line for the month, but that's over 40 basis points in the benchmark, and 100 basis points for the 1 year, and nearly that for the fiscal year to date. High yield, you know, we did the transition, hiring T. Rowe Price as new manager. That's worked out well. 98 basis points ahead on page 21 for the quarter, returning 288, and for the fiscal year, returning 943, just slightly ahead of the yellow benchmark by 50 basis points. Longer term is slightly negative, that's why there was a termination. But even longer term, going back further, there are positive numbers. And I mentioned the larger fund that the volatility has dropped, although that has changed in the last few weeks. That's where we are, unless there are any questions.
Good. Thanks, Mark.
Motion to adjourn the firefighter variable supplement?
Second.
Anyone opposed? Hearing none, the motion carries. We'll adjourn the firefighter variable supplements meeting, and we'll start the fire officer's variable supplements meeting.
Roll call trustees, Ms. Janice Emery. Here. Mr. Larry Strauss.
Here.
Mr. James McGowan.
Yeah.
Mr. Patrick Reynolds.
Yeah.
We have the full votes and the quorum. We can start the meeting.
Before we get started, I was going to make the motion. 47. The fire officer's variable supplement fund as written.
Second.
Any opposed? Motion carries. Hearing none, motion carries.
That ends all the public sessions, right?
And also adjourns the meeting.
Right. We now need a motion to move into the executive session.
Make a motion. Move it to executive session.
Of the New York City Fire Department Pension Fund Investment.
So moved?
Any opposed?
Any second?
Second?
we second it?
Second. Any opposed? Motion carries. We move to executive.